Hi, everybody. I'm Shane from 10 Capital Network. I run the events over here, and we want to welcome you today to our session about everything you need to know about revenue-based funding. We have Spring Hollis from Star Strong Capital with us today as our expert, and Hall's just going to be interviewing. If you have any questions during the session, please drop them in the chat box, and we'll be sure to get to them when we can. And with that, I'll introduce Hall, our CEO, to come on up here.
Great. Great. Thanks, Shane. Thank you guys for joining us today in the audience. If you have any questions, looking forward to answering those. And we're happy today to have Spring Hollis. We worked with Spring at Star Strong for several years now and have really appreciated her support in helping Stars find funding. And I find in these times that, when the market's down and equity is expensive and in some cases hard to find with investors, that revenue-based funding really can fill the gap that comes from that. And wanted to go through what revenue-based funding is today. Some people may know about it already, but many don't, and would welcome your questions if you are looking for something. And so I was going to ask Spring a few questions. Spring, first, thank you for joining us.
Thank you. Thank you for having me.
Great. So let's go ahead and kick off with what is revenue-based funding. Can you tell us more about what it is, just for those who are not familiar with it?
Sure. Revenue-based funding is something that is typically tied to the revenue of the business, which sounds a little obvious, but oftentimes the payments on the capital can fluctuate based off of how the top line of the business is performing. There's multiple different kind of variations on that. There are different sizes, there are different players in the market, but fundamentally what it is, it's a I'd say it's almost a non-equity, non-debt type of a capital instrument. Not equity in the sense that it doesn't introduce dilution, there's no voting rights, there isn't any kind of corresponding equity requirements. And it's not really debt either, because there tends to not be a fixed maturity date and there isn't a fixed payment schedule. So that actually creates a lot of complexity oftentimes for businesses to manage. But it is, I guess the other thing is that it's available from a number of different players, and anything from kind of $10,000 up to $10 million, $50 million. There's a huge range of available options.
Well, great. So the advantage is that it's non-dilutive and it's, but it must be paid back. And so you're not losing any equity on the cap table for it as well. If you could put out a disadvantage, what would you say that is?
The disadvantage is that I'd say it can be kind of expensive. And the expense really comes with kind of the corollary, right? What are you giving up? So you're not giving up you're not giving up the upside associated with your equity position. But the funder, who's on the other side of it, is taking a lot more risk to the performance of the business. And as a result, it tends to cost a lot more. And the cost associated with kind of RBF is borne by the business, whether or not the business is, performing to expectation. That cost is always going to come off the top, and as a result, unlike equity, where you don't have kind of traditionally a fixed dividend schedule, it's always going to have to be payable.
Great. And so, what kind of businesses does it work well for?
I'd say it works well for businesses with kind of consistent recurring revenue. Oftentimes there's really kind of two main, I'd say, cohorts of funders. So there's a cohort that is really focusing on online businesses. And in that instance, for like e-com or DTC businesses, oftentimes they will integrate into your Stripe account, and it becomes, or whatever your online payment system is, it becomes a fairly seamless exercise. So in that instance, it's very effective for those types of businesses. It's also very flexible for those types of businesses. The larger positions, so when we're talking about kind of multi-million-dollar RBF positions, tend to be a little bit more intensive, as they should be, in terms of their diligence process, but it's a similar type of company that would have repeat recurring revenue.
And so what kind of businesses does it not work well for?
Anybody who's got like a fairly chunky revenue stream, I'd say. If your revenue is much more episodic, if it is attributable to kind of particular payments, perhaps like with customer concentrations, it's less favorable for that.
Well, great. Can you walk us through an example? If I came in and said I have, 500K and it's all recurring revenue, what questions would you ask me, and what could you give me in revenue-based funding? Now, I could sit there and say I want $2 million, but I find the way it works is I tell you what I have and you tell me what I can get. What would I get in that case if I had, say, 500K of recurring revenue? And what questions would you ask?
So, in the first instance, we'd ask, who are you? Like, tell me about your business. What's your product? Tell me about your customers. Tell me about kind of your customer cycle and journey. And also the length of time that you've been in business so that we can understand, the extent to which you've been through cycles or not been through cycles, and how sticky is your customer base. So that's work that we do on our side. Typically, when you're looking at a revenue-based financing, you kind of work backwards in terms of the dollar amount of the financing, what's affordable effectively for the company, and what the top line of the business looks like. So you want to say that, okay, assuming that we want to get paid back within 12 months, and the maturity dates, kind of, and I say that with caution, can vary. We then look back and say, okay, over 12 months, what is on a monthly basis or a weekly basis, how much revenue do you bring in? And what proportion of your top line revenue can we essentially like skim off the top without degrading the kind of wherewithal of the business? So oftentimes funders will look at that and say that you don't want to be more than like 15 to 20% of the top line. And oftentimes that also has a corollary effect for what works for the underlying company. So if you don't have a gross margin that is in excess of that, it's going to be more challenging for you.
Right. So the rule used to be you could get around 25% of your annual revenue. Is that still the ballpark case?
I think it really just depends. It depends on the company, depends on the nature of the revenue. I think you can get, I think 25% is one of those frameworks, but in particular for the smaller financing positions, anything that's under $1 million, for instance, there tends to be an iterative process based off of the top line amount. So oftentimes if the financing amount is less than $1 million, often maybe less than 750, you're looking at a payback period that is typically 8 to 10 months. And so, at that point, then you work backwards again and say, all right, how many weeks is that? How many days is that? Are we taking daily payments, weekly payments, monthly payments? And how comfortable is the business surviving on that? So if you do 25%, again, a lot of it's just kind of mathematic relationships, right? Like if you have to make sure that your gross margin is more than 25%. So that kind of determines what type of a business you're going to be funding.
Right. Well, I worked with many startups that were raising funding, and at some point we would go through the revenue-based funding exercise, and we would talk about, taking 2, 3, 5% of top line revenue and paying it back. Would that work in the business model? And without a doubt, they would always push it to 10, 15, 20% to see how fast they could pay it back. But that's not really realistic. What's the most you can actually pay back percentage-wise and not put the business under?
I think, we think about it as being 10 to 15% on an annualized basis. Like it's tough. And you have to be very cautious about that because what ends up oftentimes happening is that businesses will take out multiple positions. And unless they are managing their cash in a very proactive way, it's very easy to get in trouble. Where a funder is sweeping kind of capital out of your account, the funder doesn't know what your bottom line is. They're just only looking at your top line. And they can't manage to your margin levels. You have to manage for your margin levels. So that's where it gets a little bit tricky.
Great. Well, one of the areas I found it was very interesting was when somebody was raising equity funding and they really didn't want to give up all of the ownership that went with that. And so what we would talk to them about is let's take 15, 20% of the raise and from the equity raise, and let's take that and put that under revenue-based funding. What are your rules around that?
We really like them to have strong equity support. So that tends to diminish the risk from the funder's perspective. And as a result, we can get a lot more comfortable with the business and get more comfortable kind of extending terms and being more, I'd say, I don't want to say lenient, probably not the right word, but be more flexible with the terms because of the extent of an equity cushion. Now that can be in connection with an existing raise or just because the business has been operating to path or to expectation over time. So it could go either way. That said, from a funder, from a revenue-based finance platform or debt funder, we are not looking to equity to pay us back. We really want to see the business pay us back out of operational cash flows.
Great. So, back in 2021, those were go-go days where, valuations went very high and everything was just about pure growth. And of course, those days are over now and we're back to normal living on planet Earth where we have to live with daily valuations that are more realistic. Do you see an increase in your business from that where people are saying, well, I really wanted that 25x, but now I'm getting 10x, so maybe I'll do more with revenue-based funding?
We are. We see a lot. We consistently see a lot of opportunities. I'd say we are seeing more of them starting in fourth quarter of last year. I think it's less about the valuations than about the overall pullback. So if equity is just not on the table for whatever reason, and a lot of times that has to do with external events that have nothing to do with the company itself, then folks are looking for other alternatives. And sometimes that revenue-based financing is a good alternative for that. Other times it's just delaying the pain.
Great. Well, if anybody in the audience has a question, go ahead and post it in there now. I had one more question myself. I'm seeing a related tool come up called income sharing agreements. And in that case, it's really more like salary-based funding. If you take out salary, we'll take a piece of that. And of course, we're always trying to get well aligned with the startup, and what can be more aligned than they're focusing on salary and we're focusing on taking a piece of that versus revenue itself, because you sometimes find very high salaries in a startup that probably should be reinvested back into the business, and income share agreements tend to solve that problem. What do you think about income share agreements?
And I've really only seen them in the student loan context or the kind of as an alternative to student loans, and I think they can provide a really great way for people to go to school without the burden of kind of some of the fixed payments of student loans. But I think it also depends on who the counterparty is. Some of the players in that space are kind of, I'd say, less nobly inclined, and others are fantastic.
Great. And so back to revenue-based funding, what are the reporting requirements? Do they just send you a bank statement once a month, or how does that actually work?
It really it depends. So as a threshold matter, you're going to be getting reporting once a month. I'd say that beyond like as that's out of the gate, you're never going to be in a position where it's less than that. To the extent that you are structuring financing as kind of a more frequent payback. So oftentimes they're structured as kind of weekly payback, sometimes daily, but that tends to be onerous. It can be weekly, it can be biweekly, it can be monthly. You typically have reporting that lines up with those periods. And to the extent that you are looking at taking out financing from someone who is integrating into your bank account or into your Stripe account, then oftentimes they can pull the reporting directly from that interface, which makes it really easy. At the same time, what the funder is looking for is your top line performance that doesn't have and you can get that from a Stripe account. What it doesn't tell you is what the bottom line performance is. Now, fundamentally, there's the argument that if the lender or the funder is getting paid, it doesn't really matter. But we do want to see, for us, we want to understand kind of the longevity prospects of the company that we're partnering with. So we always look for monthly reporting.
Great. Well, when someone applies for it, I see they ask for things like cash flow statements, bank statements, as well as income statement, balance sheet, those type of things. What else do you guys ask for?
We ask for all the kind of, I'd say, normal KYC type stuff to make sure that we understand who the owners of the business are. We also like to understand the use of proceeds. No, we're not subjective. We need to understand kind of, is the money going into the business or is the money going out of the business? because it does change our perspective quite often about the nature of the financing relationship. We spend a lot of time really getting to know the businesses because we, like my personal feeling is that we have just as much risk as anybody else in it. So we want to make sure that we understand and have a relationship with the founders so that we can pick up the phone and also serve as a resource for them. We look at projections. We give the same kind of hesitation, I'd say, with projections as anybody would, but we want to understand what the vision for the business is.
So I have a question in the chat box here. Let me open it up bigger so I can read it. It's basically, it says, while you're talking about payback schedules, what kind of IRR are you seeking on the typical loan of, say, 150K or so?
So again, it really depends. If you're looking at kind of what time period that you're looking at. So oftentimes the APR can be anywhere, and we're talking about different concepts. I appreciate that. The APR can be anywhere from I'd say 15 to 25. That's on an annualized basis. Obviously, it's like annual percentage rate. From an IRR or yield perspective, to the extent that it's paid back within, say, 6 months or 8 months, you're going to have a much higher yield, so IRR to the funder, than what the APR would suggest. So it's a little bit of tricky math game. The way that people talk about it, it's not apples to apples when people talk about the APR versus the IRR and the cost of capital. And that's largely because you're paying back principal on a faster basis as well.
Well, I know many investors are interested in investing in funds that do revenue-based funding. So if I gave you 100K, what kind of IRR might I get over a range of different deals over the following year? What are you seeing as the IRR that's coming out at the end of that process historically?
Historically, I'd say on an IRR basis, on a gross asset basis, it can be just shy of 100. It could be like 80, anywhere from 40 to 80%. It can be really high. And that's because, just so we kind of go through the math, right? Like from an IRR perspective, which I think of as a yield, you're investing your capital, but then it's being paid back typically either on a daily or a weekly basis. So because your capital is coming back, you can then put it back out to work in new assets. So typically, if you have, let's say you have a $50,000 position or $100,000 position at a 15% IRR or 15% APR, and that gets paid back in 6 months, then you're able to then reinvest that 100,000 into another cycle. So effectively, you end up doubling that amount from a yield perspective.
Great. So if I were to give you $100,000, what's the chance that some of these will go under? They'll just go bankrupt and the money's gone. How often does that happen?
It happens, I'd say, I think the industry average is probably about 7 to 10%, which compensates for, obviously, for the increased yield that you're getting. You're not getting it because you're not taking risk as an investor. At the same time, typically the assets will perform, at least for the short term. So you're going to have all the assets will tend to perform for, let's say, 3 months. And after 3 months, because that's kind of typically the visibility period, when people are initially taking on the financing, then the revenue cycle may decrease or it may increase. You never know, it could go either direction. But by the time you've hit that that kind of reference point, you've already recouped a certain portion of your capital because of the payback being more frequent.
Great. So one of the questions I had was, if you have a revenue-based fund, are you looking for new investors at this point?
We're always open to new investors. We operate through kind of SMAs as well as individual kind of investing accounts.
Okay. And I guess there's just one fund, or there's not multiple funds, big company, small company, or is there's just one fund that they put the money in and you deploy it according to what comes in? We
have one commingled account.
Okay. And historically, what kind of returns are those guys getting over the last 3 or 4 years?
I'd say it's probably, right now we're in the high teens.
high teens? Okay.
Mm-hmm.
And okay, so I guess there are overhead expenses. What's the management fee and carry on this?
So typically we're structured as kind of a 1% fee. And then the carry we negotiate on a case-by-case basis. Obviously, oftentimes it's split because we charge a lower fee. It can be anywhere from like, typically it's around 50% to be fair. And we pay that on a current basis.
So another question from the chat box: as an investor, should you factor in revenue and expenses? If profit margins are low, the return to the investor may not prove sufficient to justify the investment. Should you focus instead exclusively on profits?
Yes, but then it's much more like a debt instrument. So 100%, like if you are underwriting to profits, then typically you're going to get a much lower rate because the company is less profitable, obviously. For revenue-based finance, it's most oftentimes utilized by companies that are not yet profitable and can't demonstrate that bottom line.
Okay. So what kind of margins do you look for on businesses? Is there a minimum margin that below it is probably not going to work? It's just going to be too hard to pay back?
Anything that's below, I'd say 15%, 10% margin is just not going to happen. So if you're looking at kind of true manufacturing businesses, a lot of times stuff in ag, it's going to be just too tight of a margin. Even frankly, some like, cannabis at this point has gotten into to be very, very tight margins. And it's more, as a funder, you're looking at the top line. But ultimately, if the company can't bear the cost of the financing, then it comes back out of your pocket as well. So it's more about understanding kind of how those numbers really track through.
And where in the stack does revenue-based funding come in the event of a bankruptcy? There's senior debt, there's SBA loans, there's equity. Where does revenue-based funding fit?
It's a weird place, honestly, because debt's always going to be on top of it. So SBA is going to be first, most always. They're always going to have a first lien. Then if you have a so-called senior debt that's not the SBA, that's going to be second. From an accounting perspective, revenue-based finance can kind of take two different places. Some accountants like to include it as a debt position. Oftentimes we see it as an AP. So it'll be reflected as a payable on the balance sheet, which is kind of odd, but oftentimes it's viewed as a forward purchase of revenue. So it's an effective payable that shows up on the balance sheet that way. As a result, you typically get crammed down in a bankruptcy closer to equity.
Oh, really? So you don't want to be in the AP category, you really want to be in the debt category.
Yeah.
Okay, that sounds great.
Yeah, it just depends. And a lot of, like, I think most accountants and bookkeepers, there's a lot of confusion about how to book it and exactly where to book it. But so we see it all over the place, frankly, because a lot of businesses that we will underwrite to on the debt side will have revenue-based finance positions, because we do both, and we will refi out revenue-based finance positions into term loans, because term loans have a different risk profile.
Great. Are there any other questions from the audience? We're getting near the end of our time here. Glad to stay longer if there are questions, but please let us know if you have any more questions. Did you have any other comments you wanted to make about revenue-based funding, Spring, that we haven't covered so far?
I think so. I think, I say this as a funder, but also, having been on the operator side as well, you have to be cautious with revenue-based financing. Because it is taking the top line without looking at the bottom line. So that obligation is there. And we've seen a lot of companies get over their skis on it if they're not really thinking about it, because oftentimes the funder they're going to take 10% of your revenue or whatever the number is, good times or bad. So if you're running short, you don't want to be in a position where you're just kind of delaying a hard decision by taking on revenue-based financing. You want to be really thoughtful about how it's going to flow through your cash flows.
Great. Well, I worked with a lot of startups, and what we would do is take their income statement and blow it out the next 3, 4, 5 years, and then we would open up a line and say, let's say we took 250K, and we were going to do 2% payback top line, and then we would do the run the spreadsheet again and see if we went negative on the bottom line anywhere along the way, or for very long. And without a doubt, they would always push it to 10, 15, 20% monthly paybacks, which, is not annual. And so, but that wasn't really realistic. It started going red at the bottom line. So it was an interesting exercise to go run and see how much could I really do, or how much can my business model really stand? Because that was one way we do it, is just to see what I might be in the game for. But typically we're back to maybe 2%, 3% of top line, and that's about as much anybody could pull off, unless they were in very, very unusual businesses.
Yeah, I think the other part about RBF that we really haven't talked about is there's really two different kinds. One that's going to be taking kind of a fixed proportion every month out of your, or week, or whatever the payback period is. And you just pay it out, and then once you're done, you're done. Other RBF providers, and in particular some of the larger institutional ones, will look for a particular stated return upon exit. So they are going to look for instance, like oftentimes like at least a 1.75 or a 2 times return for their capital. Now they don't care over what period of time, so the IRR becomes irrelevant, or the APR on the asset becomes irrelevant. It's more a function of the multiple. And if they haven't achieved the multiple that they're looking for over kind of a stated duration of the asset, then there is kind of a fixed end date, and saying like, at this point you need to pay your 2x. And what that means is that you just get to 2x however you get there. Anything that's paid on a current basis is then deducted from your exit fee. But that oftentimes is a fairly common provision in some of the institutional RBF players.
Okay, great. Well, we have Terry Keller wanting to talk with you about this afterwards, for perhaps raising RBF for his company. And then the next question was, over what minimum period of time do you want companies providing revenue data? How far back do you look?
Well, we tend to look back like 18 to 24 months, but we're really only underwriting to something that's more current. And I'd say I appreciate that's kind of a squishy answer, but we want to see the consistency over time, the growth over time. That's not to say that if your business hasn't, kind of taken off in the last 3 months, it's not going to be eligible. It's just something that we have to be more thorough and thoughtful about.
Is there a minimum revenue that you look at that say below that revenue, this is probably not going to work? Is it 10K, 50K, 100K? What do you think the minimum threshold is there?
For us, I think we're looking at about 500K annually.
500K is a good threshold. You have to be above that to make it work. Okay, that makes sense.
Yeah,
Cool.
and again, it's like kind of just working backwards. That if you make 500K and you've got like 15% margins or 20% margins, like how much is left over? It's just kind of, a lot of it's just mathematics.
Okay, that makes sense. Any other questions from the audience? Go ahead and put it in there. Otherwise, we'll start to wrap up. Give you back a few minutes for the day as well. Any closing thoughts there, Spring? I guess one last question I had is, what's been your best case that you did it where it really made the biggest impact on the startup?
We've had a lot. We've been really, really fortunate with the companies that we work with. And one of the things I'd say, we have one company that's in our portfolio now that we started with. We took them out of another RBF position because I think it was a daily payback, and that was really pretty onerous for them. So we took them out of that and refied it into a weekly payback, and then we refied that several months later into kind of a term loan that's got monthly payments. And then we just upsized that as well. So the company's been doing very well. We've been really happy to be along for the ride. And also kind of as we see them progress and kind of demonstrate their wherewithal, we're able to extend more capital and do it on more favorable terms.
That sounds great. We had another question from the audience. Will there be a replay of this webinar? Yes, we are recording it. Anybody that signed up will get a copy of the recording as well. And then we'll be glad to introduce you to Spring to talk about your deal. And I know Terry's already signed up for that, but we'll make it available to everybody and go forward from there. If there are any other questions, go ahead and post it in now. Otherwise, we'll just go ahead and start to wrap up for today's session. I want to thank everybody's time. I want to thank Spring for your time as well. Any closing thoughts there for us?
No, thank you. I'm available for questions. This is a tricky space. It's not debt or equity. So like, if you have a question, it's because it's real. Like it can be hard to figure out.
Well, great. Thanks for joining us. I want to thank you guys in the audience. Great questions today. I see both sides here. I see the startups looking to raise funding, and I see investors looking to invest in the fund for it. And if you're interested in that, we will also connect you with Spring to talk about investment opportunities to see if that's a fit for you and how that works and how it may go. So with that, we'll go ahead and wrap up. Thank you guys for joining us today, and we'll let everybody get back to it. Have a good one.
Thank you guys.